Yes, let me start by saying it's a great honor to speak to you today. I wish that the circumstances were more favorable. I would like to say that I am awed by the bravery that you, the Ukrainian people, are displaying, and that I fully support you in your fight against Russian aggression. I have to talk today about corporate social responsibility, which is not directly relevant for your struggle, but there is some connection, which may come out in the questions. So the topic is, the question I'm asking is whether corporations have a social responsibility, and if so, what is it? I'm particularly interested in large companies, so-called public companies, whose shares are traded on stock markets. So American companies like Amazon, Exxon, Apple, or British company like BP, and so on, these Microsoft, these large companies. And many of us are invested in these companies. I don't know whether you are. Some young people will be in the future, because people, their pension money is often invested in the stock market worldwide. So my work in this area, I've been working on this for a few years, is co-authored, all of it with Luigi Zingales and some of it with Eleonora Brocado. And you can easily find the papers that are the background of my talk on my website. If you just Google Oliver Hart Harvard, you will get there if you want to go into it a little more deeply. So I'm going to divide my talk into three parts. First, the question again: do companies have a social responsibility, and if so, what is it? A very simple and striking answer to this question was provided over 50 years ago by the famous economist Milton Friedman in a New York Times article. And you can sort of understand his answer by looking at the title of the article, which is "The Social Responsibility of Business is to Increase Its Profit." So basically, that's what he was saying, that companies really don't have a social responsibility except to make more money. This sounds rather shocking to many people, but it's not because Friedman didn't think that there are social problems in the world. He thought those were best solved by governments and individuals, not for-profit companies. His basic argument was companies should make as much money as possible and then distribute that money to their shareholders, who can use their increased wealth to do good in the world if they want to. It's better for each shareholder to give to his or her favorite charity rather than having a company do it on their behalf. So at the time when he was writing back in 1970, but it's still true, companies were giving money to charity. And basically Friedman said it would be better if the companies took that money and distributed to shareholders as a dividend, and then each shareholder can decide how much to give to his or her own favorite charity. And stated that way, the proposition is hard to disagree with, and it's been hugely influential in the thinking of economists, lawyers, and practitioners ever since Friedman wrote the article. There's only one problem with his argument, and that is that it's wrong in general. And to see this, consider a company that can at some cost clean up its operations. So imagine it's polluting, but it can avoid the pollution at some cost. And assume also the law does not require it to avoid the pollution, but it can choose to do so. So Friedman's argument would seem to be that the company should not clean up, it should maximize profit and distribute that profit to shareholders. But if you think of a shareholder who is socially minded, who cares about other things than themselves, the kind of person who puts solar panels on their house or buys free-range chicken, well, such a person might prefer the company not to pollute, because they care about things like pollution. And the alternative, Friedman's alternative, which is for the company to pollute and make more money and hand it to the shareholders, well then, you know, what can the shareholders do with that increased money? They could clean up the mess. But apart from the coordination problem of them all trying to clean up the mess, there's also the simple fact that cleaning up the mess may be much more costly than the foregone profit from creating the mess in the first place. In other words, it might be cheaper not to create the mess than to create the mess and make more money and then have people clear up the mess. That seems quite obvious that that can happen. And that's a situation where Friedman's argument, it breaks down. We'll see more of that. I'm going to be more precise about that in a few minutes. But the difference, at this point, I want to make the point that the difference between charity and pollution, so Friedman's charity example and my pollution example, is that companies do not have a comparative advantage, to use sort of economic words. They do not have a comparative advantage in giving to charity. Individuals can do it just as well as companies, but companies do have a comparative advantage in avoiding pollution. Much cheaper for them to avoid it than to have people, for them to do it than have people clean it up. Now, I want to make clear that although I'm going to be talking about corporate social responsibility and how companies can behave better and solve, improve the world, I don't for a moment think that good company behavior by itself is going to solve all our problems. Like most economists, I think the biggest problems have to be solved by government, and in particular pollution problems or climate change. The way to solve that, this is one thing that there's almost universal agreement on by economists, and that's very rare. They don't agree on much, but they do agree that the solution to something like climate change is to have a carbon tax, a worldwide carbon tax. So this is what, you know, would be ideal, but it's very hard to get these carbon taxes implemented, even by a single government, let alone by having the major governments agree on a uniform worldwide carbon tax. That seems very far out of reach. So in the meantime, companies can do their part, and that's what my talk is about. Now, before we go on to the second part, let's pause briefly and ask whether shareholders really are socially minded, socially responsible. Do they care about anything other than themselves, about money? Some people react by saying no, because they have in mind the large institutions that these days own most of American companies, and I think other companies whose shares are traded on stock markets. I'm thinking of institutions, I don't know whether you're familiar with these, like Vanguard, BlackRock, State Street, Fidelity. These are the big, because we put our money into these companies have mutual funds, and we individuals often these days invest through these companies' mutual funds rather than buying shares in Amazon directly, say. And these institutions, you know, are rather kind of, they don't seem very human-like, and so people think they're only interested in money. But the thing is, you have to go behind these institutions to the people who are investing in these institutions. These are the people I'm talking about, the basic investors, and they are people like you and me. And I think most individuals, we're human beings, and we're not just concerned about ourselves. We care about other people as well. So this is what when I talk about socially minded in shareholders or investors, I'm thinking of people. Now, to the extent they are willing sometimes to sacrifice some money for the greater good, the question is, how can they make their preferences felt, and how can they push companies to behave in a socially responsible way? There are two mechanisms, voice and exit. Voice, here I'm focusing on investors, shareholders, owners. So shareholders are in a unique position to exercise voice because they have voting power. Shareholders have votes and they elect directors, the board of directors, they elect them. And so they can use that voting power to push the people they elect to behave in a more socially responsible manner. Now, I don't for a moment want to suggest that other people don't have voice as well. They do. Workers can exercise voice. Workers can complain about company behavior, and companies these days often feel the need to respond to them. Consumers can also make a fuss, but their voice is different because they don't actually have voting power. Or the power to elect. So that's why for today, I'm going to focus on shareholder voice. Now, the alternative to voice is exit. What do I mean by exit? In the case of shareholders, I mean divestment. Or what you do is, if you don't like a company's behavior, you sell your shares, you get out. That's exit. And I'm going to talk about both mechanisms. But my talk is mainly about how voice, I think, can be very powerful relative to exit. But let me just go on to say there are other forms of exit. Consumers can exit, workers can exit. Consumers can refuse to buy the product of dirty firms, or workers can refuse to work for dirty firms. And in fact, in my paper, which you can find on my website, Exit versus Voice, my co-authors and I look at exit by workers and consumers as well as by shareholders, but time is short today, so I'm just going to be discussing exit by shareholders. So I'm going to compare voice by shareholders and exit by shareholders. Now, many people, including young people, Harvard students, it's certainly the case for them, seem to favor exit, divestment. And they've persuaded Harvard University to announce that it's going to divest from oil stocks in the next few years, as opposed to trying to use its voice. So I'm going to argue actually that that is perhaps the wrong strategy. To see the power of voice, so people are less familiar with voice than with exit. So as I said, I'm going to focus in the talk mainly on voice. And I want to use a real world example to show you how voice can be powerful. So this is a real world example. It's historical because it happened nearly 40 years ago. And you'll see why I use this example. It's because we have some numbers. In 1984, DuPont, the big chemical company, faced a choice between polluting the Ohio River with a toxic substance known as PFOA, or avoiding the pollution by incinerating its waste, by burning it. Now, they decided to, not to give too much away, but they decided to pollute, not to incinerate, back in 1984. And eventually, there was litigation about this, and the case ended up in court, and DuPont had to pay some damages, although not very much, I think. And the advantage of this is because it ended up in court, a lot of information became available, and various calculations can be made on the basis of that information. And here they are, that in 1984 dollars, the cost of incineration, of avoiding the pollution, was $19 million. And the harm that the pollution caused, because they did actually pollute, they didn't clean it up, the harm can be estimated to be $350 million, again, 1984 dollars. Now, this represents the sickness and deaths that occurred as a result of this toxic substance being dumped into the Ohio River. Okay, so 19 versus 350. Now, economists, I don't know how many people in the audience have any sort of economic training, but an economist will look at those numbers and immediately say, of course, the efficient thing to do would have been to incinerate, because 19 million, the cost is much less than the benefit, which is you avoid the illness and the deaths. That's worth 350 million. But as I say, DuPont decided to pollute, not to incinerate. And maybe why? Maybe because they were influenced by Milton Friedman. They thought that was the right thing to do. Or maybe because they were incentivized, the top managers were, had shares in the company or stock options. And so they wanted to maximize the share price. Now, what I want to argue is, suppose this decision had been put to the shareholders of DuPont. So this is voice. Suppose they'd been allowed to exercise voice. They'd been allowed to decide this themselves rather than management, have the shareholders decide. In just a simple vote, do we incinerate or don't we? Now, to understand how somebody might vote on that, might have voted, I'm going to use today's numbers. An investor who has about $500,000 invested in the US stock market, let's imagine someone like that, who, in other words, someone who is certainly fairly well off, but not extremely rich by American standards, $500,000. And let's suppose they hold what's called an index fund. So that means they hold a little piece of every American company. A lot of people do invest that way. So with that amount of money, you would own a 10 to the minus 8th of the total US stock market. What does that mean? That means 1 over 100 millionth of the market, which means you own 1 over 100 millionth of every company whose shares are traded in the US stock market. And that means in particular DuPont. You would own, so such an investor would own 1 over 100 millionth of DuPont. Okay, so think of this investor voting. The way he or she would think about it, or should think about it, is which outcome would they prefer? They may as well vote the outcome they prefer. It's just up or down, a single incinerate or not incinerate, no reason not to vote the outcome you prefer. Okay, so if the outcome is incinerate, that means the company pays an extra $19 million. Now, you holding 100 millionth of DuPont, the company is going to be worth 19 million less, but 19 million divided by 100 million is 19 cents. This is the personal loss you would take from lower dividends or a lower share value. 19 cents is the cost to you of incineration. Now, what is the benefit? Well, if you are a socially responsible person, you're going to look also at the effect of this on everybody else. It's minus 19 cents for you, but for everybody else, what is it? Well, there's a gain of 350 million in terms of less illness and fewer people dying. But then, of course, your fellow shareholders, you care about them as well, let's say, and they're going to have to pay 19 million minus your 19 cents. Okay, well, we can forget about that. Basically, 19 million they're paying. So that means the net social gain is 350 minus 19. That's $331 million. So the question you face is, are you willing to give up 19 cents for a social gain of $331 million? Well, I would like to think there are not too many people who would be unwilling to do that, right? 19 cents, trivial. $331 million, that's a lot of money. That's the social gain, the net social gain from incineration. So my view and that of my co-authors is that the vast majority of people would be willing to make that trade-off. And so if there was a vote, the majority would be voting to incinerate, which of course was not the outcome that DuPont chose. But the point of this is to show, of this example, I think, it's pretty striking. I hope you think so too. And the example is intended to show that if companies listen to their shareholders rather than blindly maximizing profit, they may end up behaving in a more socially responsible way. Now, I want to compare that to an exit strategy. Here I'm going to be briefer because actually to show the argument properly, it requires some work. You would have to look at the paper, exit versus voice. You actually need what economists call a model there's some mathematics, and I can't do it in a short amount of time. But let me just sketch the argument. So imagine that instead of voting, shareholders decide the way we're going to try to influence DuPont is by selling our shares. So specifically, let's suppose 10% of the shareholders, perhaps the most socially responsible, announce that they're going to sell their shares in DuPont if it does not incinerate. Okay? Now, how is this meant to affect DuPont? Well, the point that we can see it actually quite clearly in the following. If other investors cannot adjust their portfolios, then if DuPont decides not to incinerate, and 10% of the shareholders are now sell their shares, well, there are no buyers. So the share price will drop all the way to zero. Supply exceeds demand. And this, of course, would have a huge effect on DuPont management because, I imagine they were themselves shareholders as part of an incentive scheme. This is very common to give management either shares or options to buy shares. So when they see the share price dropping, they think, oh, this is terrible. What can we do? Well, we'll change our strategy and announce we're going to incinerate, and then all these shareholders will come back and the share price will come up again. Okay, that would, if that was the end of the story, then this divestment strategy would be hugely effective. But of course, it's not the end of the story and the reason is other investors can adjust their portfolios. And indeed, what's going to happen is that as the share price drops, the less socially responsible shareholders or investors will see a great buying opportunity because DuPont is just as profitable as before. It's not even going to pay that extra 19 million. So it's extremely profitable and its share price is very low. So this is a great investment opportunity. And so they're all going to pile in and the share price will come up again. And indeed, this happens in practice. The Financial Times not so long ago reported that hedge funds are scooping up the shares of oil companies dumped by socially responsible investors. So when Harvard divests, the hedge funds say, great, we'll buy the shares. And that will drive up the price of shares. And what you can show is that in plausible cases, the price rise will be enough that a value maximizing manager will decide not to incinerate. Indeed, and this is what I can't really show you this, but I can only just state the result. You have to look at the paper. What we show in the paper is that for divestment to lead to DuPont, actually it's the model we have has lots of firms just like DuPont. And we ask, will a divestment strategy lead to them all choosing to incinerate? And the answer is it's only going to work. It's only going to happen if all investors, basically all investors are willing to give up 19 cents for a $4.7 social gain. So that's a much more incredibly more stringent condition than the one we had previously for voice. So you just compare the two conditions. The voice condition, for voice to work, to get DuPont to incinerate, all you need is a majority of investors who are willing to give up 19 cents for a social gain of $331 million. Whereas for divestment to work, you need not just a majority, but all investors to be willing to give up 19 cents for a $4.7 social gain. Well, I would say it's not going to be hard to find people who are not willing to make that trade-off. 19 cents for $4.7, it doesn't sound maybe worth it. So that's just, as I say, I can't really give you the intuition, much of the intuition, except to say that what's driving this is precisely the fact that when socially responsible people will sell their shares, there are going to be people out there who are not socially responsible. We're going to say, great, the share price is falling, I'm going to buy the shares. And as long as there are those people around, a divestment strategy is not going to be strong enough to get managers who are value maximizers, who want to just maximize the share price, to respond. sufficiently. Okay. I'm going to, in the last part of the talk, I want to discuss voice in practice. There are these days still some quite serious limitations on voice, on shareholders being able to use their voice. So one set of limitations come from the fact that, as I said earlier, most stocks, most shares are owned through mutual funds, not directly. I do not. I have some money in the stock market, and most of it is, particularly through my pension at Hart, my Harvard pension. Most of it is owned through mutual funds provided by institutions, the ones I mentioned: Vanguard, BlackRock, State Street, etc. And these institutions actually typically vote on my behalf, and these institutions are extremely important now in the U.S. stock market, because the big three, Vanguard, BlackRock, State Street, own, actually I think it's more than this now, but certainly at least 15% of most US companies. And that's a lot when it comes to voting, because a lot of people don't vote. And so one can ask, how are they voting? They're voting on our behalf. Indeed, they say, if you look at what they say about how they vote, they say they have a fiduciary duty. Now, I don't know whether you're familiar with that term, but it's a legal term. It means a duty of loyalty. So they have a duty to act on my behalf and on the behalf of other people who invest with them. But they interpret that to mean, what does a duty of loyalty mean? For them, it means maximizing long-run financial return. So they think they have a duty to act in such a way, including when it comes to voting, to maximize long-run financial return. And indeed, this is part of the law. So it's not just that they think this, but in many cases, the law says that that's what their obligation is. So to me, that suggests that if they were voting on that incineration project that I was talking about a few minutes ago, they would have to vote not to incinerate, because long-run financial return is, there's that $19 million that you have to pay. Now, of course, people might say, well, wait a minute, what about the litigation risk, the risk of lawsuits? Well, it turns out that, if you go back and look at DuPont's thinking in 1984, they weren't too worried about lawsuits. And so probably institutions at the time wouldn't have been worried too much about them either. So they would have just been saying financial return, it's maximized by not incinerating. Now, my co-authors and I think this makes no sense. A duty of loyalty should mean acting on behalf of your investors. But if your investors care more than about just money, that surely the institution should take that into account. And in my example, 19 cents versus $331 million, I was suggesting that most people would want DuPont to incinerate. So surely, in that case, the institution should vote incineration. But as I say, the current system, the current situation is they may be reluctant to do this. How could we improve things? Well, at least three approaches are possible, and some of them are actually being used. So one is to have individuals vote themselves. So instead of having Vanguard or BlackRock do it on our behalf, and maybe incorrectly by just looking at the monetary side, why not let us vote ourselves? And BlackRock is actually doing this. Recently, it's announced that it will allow its larger investors to vote themselves. Now, one problem with this strategy of having individual shareholders vote is that it puts a big burden on them, because if you think about it, well, there are 4,000 roughly companies traded on the US stock market. And I'm sorry to be only talking about the US, but it's the one the place I'm most familiar with, and it is, of course, a big player in the world. You have about 4,000 companies. Now, each company has an annual meeting with several things to vote on. And, you know, there are 365 days of the year. So that means about, if you think about it, about 10 votes a day or more. And that's just too much for any ordinary person to keep up with. You know, we have other things to do. We have day jobs, right? We're working. So we can't be spending all our time thinking about shareholder votes. Fortunately, there is a way out of this, which is that a big advisory service to companies called, or to investors actually, called Institutional Shareholder Services, ISS, has produced voting guidelines. So basically, these are things where they sort of say, look, if you care a lot about labor, about workers, you might want to vote in this kind of way. And or if you are religious, maybe you're Catholic, you might vote this way. Or if you are very concerned about climate change, you might vote this way. Not on any particular company, but in general, they sort of lay out these guidelines for how somebody with these sort of preferences might be voting. And then you can select a guideline, and then they say they will vote on your behalf using that guideline. So that way, you don't have to do all the voting yourself. You've basically delegated to someone who says they're going to vote according to your preferences. That could happen in the future. It's not happening now, but you could, actually, sorry, it is happening now to some extent, and it could happen more. We could all be given that choice to select a particular guideline. Another possibility is for mutual funds to, like BlackRock, say, to approach their investors, people like me, and say, what kind of trade-offs are you willing to make? Are you willing to give up 19 cents for $331 million social gain? To which I would say yes. Then they could say, well, okay, are you willing to give up 19 cents for $1 million social gain? To which I would say yes. What about 100,000, 10,000? You know, and at some point, some people would say, no, I'm not willing to do that. And then, you know, having learned these kind of trade-offs from the investors, then in the future, BlackRock could vote on our behalf, but aggregating our preferences. So again, for people who have an economics training, may be familiar with the idea of preference aggregation. And if you are, you may also know that there can be some problems with it, because people might not report their preferences, their trade-offs truthfully, but there are also clever mechanisms to get around this problem. So this is a possible approach as well. Requires much more research, but it's at least a possibility. A third strategy, and I'm nearly finished, but a third strategy, and this one is also being used in practice, is for some mutual fund companies to set up offering funds with a clear voting strategy. So an example of this is engine number one, which is a now famous hedge fund. The reason it's famous is that a few months ago, it's a very small hedge fund, but it managed to get 3 people elected to the ExxonMobil board of directors against the wishes of management. So these were dissidents, and they managed to do this because they persuaded the big institutions to support them. And so they became famous, and partly as a result of that, they were able to set up a fund called the Vote Fund. Now, what is this? It's an essence, it holds the largest 500 American companies, right? It invests in them. It's not actively managed in terms of buying and selling shares. It's just a passive fund, what's called an index fund, but it is active in terms of its voting strategy. So it's announced how it's going to vote on some issues. And in particular, it's said that it's going to be pushing companies to be greener. So, you know, if you like that idea, you put your money with them, and then they are active on your behalf. You don't have to be thinking about the voting yourselves. Okay, so I just want to end with some evidence that voice is becoming louder. People are exercising voice more than they used to. So here are some examples of things that happen in 2021. These are shareholder resolutions that were voted on. And historically, there have always been shareholder resolutions. So these are things that shareholders put up and get at a company meeting, and they're voted on. But historically, they've received very little support, right? And so they were easily ignored by management. But here are some examples in 2021 where things worked very differently. So 81% of DuPont, okay, it's DuPont again. It's not back to 1984 though. This is, DuPont still is polluting, but in different ways. And 81% of DuPont shareholders approved a proposal requiring the company to disclose how much plastic it was releasing into the environment. 64% of ExxonMobil shareholders approved a proposal requiring the company to describe if and how ExxonMobil's lobbying activities align with the goal of limiting global warming. So it turns out ExxonMobil lobbies to avoid, to make regulation less likely. They're trying to stop regulation of carbon emissions. And basically shareholders of ExxonMobil are saying, wait a minute, we're not sure we like that idea. And so they want more information about what they're doing. 52% of Duke Energy shareholders approved a proposal requesting disclosure on political contributions. Same sort of thing. Who are you giving money to? Maybe people we don't like. 95% of Wendy's shareholders approved a proposal requiring the company to disclose how it's treating workers, particularly with respect to COVID-19. To be a little more systematic, here you can see a picture that shows you how things are changing. So if in 2016, only 29% of shareholder resolutions got over 30% support. In 2021, it was 54%. If you look at resolutions that got majority support, it was only 3%. This is the green band. Only 3% got majority support in 2016, whereas in 2021, it was up to 20%. So the world is changing. And I think in the future, shareholders may be able to push companies to be socially responsible, which I think maybe this is optimistic, but I think it can improve the world. Let me stop there. Thank you very much.
Thank you very much for a great presentation in your lecture. And now we will go to Q&A session. We have a first question. Do you think that humanity overcome global warming and pollution of ecosystems?
Do I think humanity will Could you say it again? Will overcome?
Of course. Do you think that humanity will overcome global warming and pollution of ecosystems?
Well, I don't know. I'd like to think so. I hope so. But you know, my view is it requires pressure at every level. Individuals have to do stuff, companies have to do stuff, and governments have to do stuff. I'll just throw in one thing, that one advantage some companies have is that, you know, they're multinational, so they operate in several countries, and so actually maybe they can do things that it's hard to get the governments of these, you know, coordination of the governments of these countries can be very hard to agree on a worldwide carbon tax, for example, as a way forward. But a company that operates in several countries can actually, you know, its shareholders can be looking at the pollution over all those countries, and actually push the company to do something good. But okay, I'm hoping, but I don't know.
Thank you, thank you. Okay, the next one, Mr. Obler. What do you think pushing corporation to be more social responsible in general will be more profitable for world economic development, or maybe it can lower speed of economic development?
Yes, that's a good question. I think there are trade-offs. So one of the things that you find if you talk to people, practitioners, fund managers, and managers of companies, they seem to be always talking about win-win. You know, they think that you can improve the world and make more money. But I fear that's not always the case. So sometimes we have to accept a trade-off. So again, look at my DuPont example. There, it was a matter of, are we willing to reduce profit a bit for the social good? And I think I think the answer is sometimes we will be willing to do that. But undoubtedly, that can sometimes mean less growth.
Okay, thank you. The next one is, does it make sense to tighten corporate social responsibility legislation?
Well, the thing is, does it make sense to have legislation? Sure. As I say, I don't know whether it would be, yes, it would be something like, let me go back to a carbon tax. You know, a carbon tax is, what that would mean is that a company that pollutes, that emits carbon, would have to pay for it, pay the damage that is causing to the environment. This is what economists like that idea. It's called a Pigouvian tax. And there's a famous British economist, Arthur Pigou, who came up with this idea that this is the way to deal with what economists call externalities. So, okay, so, you know, then companies can maximize profit, because the point is, if they do damage, they're paying for it. And so they will naturally do the right thing. So I'm in favor of that. But the trouble is, you know, I was saying it's very hard to persuade politically. That is a hard sell. A lot of people don't like, you know, citizens don't like that idea. And to get it agreed on across countries is even, you know, is 10 times harder. So the thing is, I'm not sure you know, if you can legislate on corporate social responsibility, why can't you legislate on the carbon tax, which would be a better approach altogether? I guess that's my answer.
Thank you. The next one is a little bit bigger. It's a question to the 19 cents and $4 issue. Is working when the legislation works. However, in Ukraine or other countries, environmental issues are not clearly defined in the laws. So the company may simply pay a small fine or do nothing at all. And thanks to the work of the company's legislator and lawyers, what to do in that case?
Well, that's exactly my argument. That's why I was suggesting that if shareholders had more say in the decision, they might actually do the right thing. That's the best case scenario for what I'm talking about, where the company knows that it doesn't face much risk if it pollutes, because nobody, you know, there's no, the fine, if there is a fine, it's going to be quite small. So it could go ahead and do it, and that would be profit maximizing. But if shareholders knew about this and could push the company, they might say, we don't want that extra 19 cents for each of us. We would prefer the company to do the right thing. So I think that's exactly the situation where a voice can be good.
Thank you. The next one is how to motivate corporation to socially responsible activities.
By having the best thing, I'm asking for shareholder democracy. So just to, yes, maybe there's something I should say, this is important, which I missed out, but it's, so why do I keep on talking about shareholders? I said they had the votes. The thing is that companies are set up, so some people say companies should act on behalf of stakeholders, not shareholders. They should act on behalf of workers or consumers or the local community or the global community. My problem with that is that companies are set up, the people who found companies choose how they should be governed, and they typically give the votes to the shareholders, not to the workers and not to the consumers. They can do that. Sometimes there are companies out there that are worker-owned or consumer-owned. They exist, but most companies are owned by their investors. And I come from a tradition in economics which basically says, let people do their own thing unless there's an obvious reason for them not to. So let people enter into the contracts they like. If you and I want to have an economic relationship with each other, we should be allowed to do that. No one should intervene. And similarly, if I set up a company in a particular way and I give the votes to a particular group of people, we should allow that. And that's why, because most companies give the votes to the shareholders, I'm taking the view that that means the company should act on their behalf. But then I argue that the shareholders are not only interested in money. So that's, sorry, I'm not sure that's a long way. What was the question again?
Okay. It was how to motivate corporations to socially responsible activity.
Well, that's it. So the way you do it is by asking the shareholders what they want. And of course, I can't be sure that the shareholders are going to want what I want, but I still think shareholder democracy is better than managers just deciding themselves what should happen and assuming that the shareholders want as much money as possible, which I think is not correct, always.
Thank you. Practical usage of contract theory in the field of encouraging corporation to greater social responsibility. Do you see such a complex connection, and if it exists at all?
Well, there is a connection, which is as follows. Another way, so I haven't talked about this, but another way that a company can be more socially responsible is if it relates to what I was just saying, my answer to the last question. Think of the person who sets up the company. So I don't know how much the audience knows about this, but the way it works is, you have a founder sets up a company, and then if it's successful, it may become a public company through what's called an IPO, an initial public offering. Now, at that stage, when shares are sold to the public, the company will have a charter. So it will say what it's about. And typically, the charter of companies says very, very little. But it doesn't have to be that way. So as a founder, you might decide you're going to be getting out of the company, you're going off and doing something else, or you're retiring, but you would like your company in the future to be socially responsible. You might be that kind of founder. You're socially responsible yourself, and so you want the company to behave in a good way. So you could put into the charter something about how it should behave. Indeed, there are companies now called, what's the name? Benefit corporations that have a purpose which is stated. We're not just going to be about making as much money as possible. We're going to have other goals. So in a way, that's like a contract between the company and its investors. When you buy shares in that company, you know that the company has said, we're going to be doing other things than just making money. So that is the kind of contractual solution to some of the problems.
Please, thank you. And the next one, so a lot of questions. How to solve the problem of disagreement about social responsibility between the majority and minority shareholders if the minority shareholders themselves offer its implementation in the company's actions?
Sorry, not sure I quite got that. You said majority, how to
solve the problem of disagreement.
Disagreement. Oh yeah, okay. It's a good question. I mean, I think there are two possible approaches, at least. I mean, one is the simple voting. In my example, DuPont example again, I imagined a vote on incineration, and you know, there could be some people who are not willing to give up 19 cents for $331 million. They're completely self-interested, or they may, you know, for whatever reason, they might vote no. And let's suppose they're in the minority. Well, you know, my first reaction is that's tough. You know, just as in political elections, we have a vote and the majority wins and the minority has to accept it. So that's one answer. A second possible answer, and this relates to, you know, what I was saying about, I was talking about institutions, the investing institutions, but it's also true of companies. Companies could learn about the preferences of their shareholders, you know, what trade-offs they're willing to make. And they might even find out that the minority feels much more strongly about this issue. So they could do, somehow take that into account. You know, if I'm willing to pay a lot for something, but let's do it the other way around. So suppose the majority vote against incineration, but the minority actually have made it clear they're willing to give up a lot of money, a lot of profit to have incineration. Then you could imagine the company would find a way to compensate the majority for the intense preferences of the minority. And even though the majority would vote against because maybe some transfers take place, the final decision will be to incinerate. So you could imagine something like that, but that's more complicated. I think the simplest answer is it's like politics. If the minority just has to accept that this is majority rule and they've lost.
Okay, thank you. Thank you very much for a great lecture. I would like to invite you here where it will be peaceful and safety. I hope we will meet in person, not online. Thank you for a great lecture.
I feel exactly the same. Yeah, and thank you so much for Dimitrov for moderating.
Thank you very much.